ultimately it's the same diversification strategy now that I offer to my investors. And the goal here is to diversify across asset classes, operators, geographies within the country, business plan, and now I'm also including vintage as well. So it's almost like the dollar cost averaging idea, but across multiple different investment picks.
Welcome to the Peak Profits Podcast, your guide to maximizing returns in passive real estate investing. Hosted by Bryan Morris and Chris Ward of 7 Peak Capital, we dive into conversations with industry experts, sharing insights, strategies, and stories to elevate your investment portfolio. Whether you're a seasoned investor or just starting out, this podcast is designed to give you the edge for financial freedom. Get ready to unlock new opportunities, discover the secrets of successful investing, and take your passive real estate investments to the next level. Now, let's go reach those peak profits together.
Welcome back to the Peak Profits Podcast. Today, I'm excited to introduce our guest, Randy Smith, founder of Impact Equity. Since launching in 2022, Randy has guided over 100 investors to place more than $9.5 million into multifamily syndications and other passive opportunities. With hands-on experience as a passive investor in over 25 deals across 11 operators, Randy has a unique ability to simplify the process and make passive income accessible to everyday investors. We're going to dive into Randy's journey, hear how he helps investors create financial freedom, and share some actionable insights so you can put into play. So let's get started. Randy, it's a pleasure to have you on the podcast. We're excited to have this conversation with you today.
Yeah, excited to be here, guys. Thanks so much for having me.
Of course. No, I know we've known you for some time now, and we've been going back and forth about several deals and everything that you're doing there at Impact Equity. So excited to have you on the podcast. Why don't you go in and just start us from the beginning, what you're doing today with Impact and kind of how you got started with that, and we'll go from there.
Yeah, absolutely. So I was a sales guy for 25 years. Spent the very large majority of those 25 years with 2 Fortune 100, Fortune 200 organizations, leading sales teams, carrying the bag, doing all the things that you guys know so well.
We do today. Yep.
Yeah. So did that for a number of years, and I reached that point in my career where I started looking at the 401k calculations and started trying to put together a timeline on when I could exit the W-2. And it became very apparent that I needed to do more than just save in a 401k. So I started looking at real estate like so many do. And I ended up going down the single family route and bought a bunch of houses out of state, managed big construction projects from 3,000, 2,000 miles away, and found out pretty quickly that active real estate investing in single family homes was not something I cared to scale, enjoyed, had any expertise with. So I decided to become just a passive investor. And that's kind of where my journey started in this space.
Yeah, it's another job for sure. When did you first start getting into real estate on the active side, like when you were buying those houses and kind of get into the industry?
Yeah, so it was 2018, I believe. So we had a couple of years before COVID hit, but about, I guess, coming up on 7 years ago. But what I don't share is that I sat on the sidelines listening to Bigger Pockets and all the podcasts for probably, it was probably 5 years.
Yep.
I think about all the, I was in outside sales the last 10 years of my role. So all the windshield time I'd spend on podcast for like literally 5 years. So sat on the sidelines way, way too long for sure.
I think that's a common theme for a lot of people, probably a lot of listeners to this podcast as well, that have either thought about getting into real estate, maybe looked at single family houses on Zillow. I know Chris and I's paths are a little bit different when it comes to it, but that's something that he's done in the past as well. And, I started back in 2016. I was doing the same thing, read books, listened to podcasts. But you get that like analysis by paralysis, right? You're like, when do I make the jump? How do I make the jump? Do I actually know what I'm doing? So it seems like you decided to make the jump and quickly realized active wasn't the path you wanted to go.
Yeah, and, I think it's a really good point. You bring that up where you talk about the analysis paralysis piece, and I think we're all guilty of that. Usually, the advice that I give to folks that are just getting started is just get started. Like my strategy has changed a half dozen times, probably more than that in the last 6-7 years. But I never would have gotten to where I am today without the first 3 or 4 or 5 different renditions of what I'm doing today. And it's I heard somebody say, like, it's a lot easier to steer a moving ship than a ship that's not moving. And I think that's so true. You just start taking action and you can adjust along the way.
Yeah, I would say I've definitely fallen into that analysis by paralysis, especially during COVID. That was a lot of what I was trying to do to find my first investment property. Randy, I was also doing looking at out of state. Being in Manhattan wasn't really an affordable area for me to buy the investment property. So when you talk about kind of the benefits to active investing, and there obviously are a lot of benefits. That's what most people naturally fall into. You buy a house, you may move into a new home, you may not be able to sell the old home, and therefore you just immediately become an active landlord. What would you say are the major benefits that you've seen being on the passive side versus what you were seeing as an active investor?
Yeah, I think it's interesting. And I don't know that you can use a blanket statement of saying active is the right route or passive is the right route. It really depends on the individual and what kind of resources they're bringing to the table. So, the three of us being sales professionals, generally, if you are performing at a high level, one of the assets that comes to the table for us is that we get quite a bit of autonomy and we can really manage our days if we're performing in our roles. So if you've got the flexibility and the autonomy to manage your day, then active investing could be a really good option for you. What I found was that I was doing pretty heavy construction projects I was doing the BRRRR strategy. And there was a point where the construction responsibilities and the management of those projects was actually pulling me away from my W-2 job. And I was in a W-2 job where it was very, very clear to me, like, if I spend X amount of hours doing this job, I can create Y amount of income. And it was substantial, probably far more than what I could have actually earned, guiding project managers doing a BRRRR strategy. So I think it's really important just to understand, what resources do you have? Do you have time? Do you have expertise? Do you have, a deep pockets or dollars to invest? And then that will tell you, like, where your time is better spent or where your resources are better spent. As it was for me over time, it looked like I was creating very, very good income in my W-2, and I needed to find a place to get those dollars working for me. But I couldn't really pull away the time that I would have had to dedicate to build, a scalable single family portfolio. So I'm not sure if that answers the question. I kind of went around on it, but I think it's important to have a good understanding of where your resources are.
I think you make a good point there when you kind of talk about the notion of creating active income through a W-2 and then taking that income to invest in passive opportunities. And I think that's kind of what Chris and I have both, that light bulb moment that we've realized is, you can earn good money in a sales role, and we dedicate, most of our Monday through Friday to our W-2 job. But we do have that balance and autonomy that we're able to make a good earning. And then we've identified real estate as being the place where we want to place a lot of that capital. And I think a lot of people, like, when you're talking about real estate, people are like, you have to get out of your W-2 job and jump right into real estate. And I don't think that's necessarily always the case. I think the more that you can scale, it's almost like putting gas on a fire. Like, it starts to ignite it quicker and you can get into more deals. And then eventually, when you feel comfortable to make that jump, I think that's when, the important decision. And ultimately, I guess that leads me into your thing. You've made that jump now, right? You've started Impact Equity. You were making a great earning at your W-2 job, but now you're doing this full time. Why did you decide to do that? And what did you feel was like that major moment where you're like, I can now take this full time?
Yeah. So mine was not so much of a jump. It was more of I got pushed because I did get the layoff. I got the nod. I got that VP call on a Friday afternoon that, everybody hates to get. So mine was a little bit different. I ended up getting laid off, but I had started aggressively passive investing in conjunction with doing these BRRRR strategies as well. So when the call came, it was not a devastating blow for me in this household. Now, what I'll share with you is 10 years or 11 years prior, I got laid off from another position, but at that time I had not started in investing, and that was an extremely scary time where, even though I did get a severance package on that first one, like every week and every month that passed, like the end of the severance was just around the corner. And that was a really, really scary time for our household. So I had that in the back of my mind when I started investing, 5 years later. So fortunately, my journey was one where I did active investing. And thank God I did when I did. I shifted over to passive, and I had thought about this capital raising space because, being a sales guy like you guys, I'm telling everybody I know what I'm doing, and people are interested. They want to hear what it is that I'm doing or possibly get involved. I just wish I would have started earlier, like you guys are doing, because, I shared earlier on the podcast, like had I started 5 years earlier, I could have easily made $1 million plus in this business before I even left the W-2. So I think the message to the listener is, if you can carve out a portion of hours on a weekly basis, like that's all you need to create a very lucrative business in this space. At a minimum, start the education journey and jump in and get going. So,
yeah, and I think you raise a good point there about getting started earlier. I sit there and I think about that every single day. It's like, why did you not start this earlier as well? So I think, to your point, getting started now is in 5, 10, 15 years time, you'll look back and you'll probably even think, I wish I started earlier, regardless of how old you are or when you do begin that. But one of the things, Randy, I think based on our conversations that we've had so far and what I know of you as a person is you go through a lot of due diligence, right? It's not something that you would just see, I see an email here or I see a post on social media, I'm just suddenly going to invest. You truly do go through a very thoughtful process. You've got a document that we don't have to go into every single detail of that document because it's quite extensive, but your due diligence process is very, very detailed. And it would be great if you could share a little bit more about that due diligence process that you went through for your first few investments that, again, I'm sure has changed from that first one or two to what you're doing now, but how you started to go and really identify what is a good opportunity for Randy. Because, again, one of the important things for everybody to think about is what is your own risk appetite? What you may be comfortable investing in today may be very different to what myself and Bryan are comfortable investing in. So if you could share a little bit about that, that would be great.
Yeah, well, it's definitely been a journey. When I first started, you don't know what you don't know. So I did what a lot of people do, and I listened to a lot of podcasts. I read a lot of books. I had what I considered like long-term knowledge of a handful of people in the space that I knew, like, and trusted just by having exposure to them through those different channels. And, it's just like anything. Being salespeople, you generally, over the years, you get very good at reading people, reading their integrity, kind of watching them work, and you can make a pretty good assumption as to the type of people that they are. So early on, I really just aligned myself with people that I trusted, that had very large social presences, that had a lot to lose if things didn't go well, and they were the experts in the field that I knew at the time. Now, I will share, as you mentioned too, like my due diligence looks very, very different today than it did back then. Like it's just obnoxious, like how many questions I go through, and it's like an interrogation almost when I'm going back and forth with operators. But as your education and as your experience and your sophistication continues to improve, you will just become a better due diligence. You'll just become better at that process. So generally, when you're looking at deals, you're always betting on the jockeys. So you're betting on people. not necessarily the job. You're trusting them because, kind of going back to the thing that we talked about earlier, like we are bringing dollars to the table. That's our superpower as a passive investor that we're bringing to the table. What they're bringing to the table is their expertise, their track record, their knowledge, their know-how, their experience with the market, all of those types of things. So it's really bringing those together for the best possible investment. So I think a lot of people get they get scared about placing that first investment because they don't think that they know everything. And the short answer is they don't, but you will never know everything. So that's why some of the other strategies with investing come into play as well. So we can dig into those, but ultimately you're betting on the jockey. So find a jockey that you know, like, and trust, and then put a small investment with them before placing more capital.
Yeah, and that's a good point. I think as you go through this journey, right, it's never a get rich quick. It's get rich steadily, right? As you invest in multiple deals and start to build and accumulate wealth. And I think to your point, that due diligence process, as you go through deals, you start to identify maybe things that you should have looked at or dug a little bit deeper in previous deals, and that only gets better deal by deal. So when it comes to operators, markets, asset class, what are you specifically targeting? What are you looking for? Like, what do you feel most comfortable investing in with impact equity?
Yeah, so we have a huge affordable housing issue in the United States, and we will likely have a huge affordable housing issue certainly for the next decade plus, as we don't see, even either of the options that we had with this new administration coming in. We're not really solving for the challenges that we have. So I like affordable housing. I very specifically like multifamily. I have a tendency to place my capital in the Sunbelt states, or the Smile states as they call them. So Smile states is a new terminology that I've been hearing lately too.
Yeah, but I like it.
I used to say Sunbelt, but now like we're going up both sides. So that's where the Smile comes in. But primarily I'm investing in red states. And I think it's important that, the listeners look at that as well. Like not to even share a political view, but doing business in red states is generally easier, and that generally makes investment options better. So I'm investing in multifamily. I'm investing with very large institutional quality operators, and I'm in the Smile states and trying to diversify as much as I can.
Awesome. In terms of the other things you look for as part of your due diligence process, you obviously track record is extremely important. You've mentioned the specific markets that you are identifying for yourself, and ultimately the opportunities that you would be bringing to your investors. How far into things like the underwriting, the debt structures and stuff like that do you ultimately find yourself going into, or are you looking more at what are my overall returns? Like, how do you kind of piece together, this is a deal that Randy wants to go for?
Yeah, good question, and probably the most important question. Underwriting, ultimately it's an Excel sheet, and it has different levers that you can pull. So you've got debt, you've got entry and exit cap rates, you've got assumptions about increases in expenses, and assumptions about what's going on with increases in revenues, right? So those are kind of the levers that you can pull, and very, very minor adjustments to any one of those levers can have a very, very dramatic impact on the overall return. So, I joke sometimes that I think there was probably an investor presentation deck that was sold for like $19.95. That is, double your money in 5 years, 4 to 6% cash on cash, and 20% average annual returns. And I say that because literally 95% of the investor decks that you see will have those exact returns. So what you really got to ask is, what's different from, the litany of different investor decks that you see? And it comes down to those assumptions that they're putting into their models. And ultimately, every single operator you run into will say that they're conservatively underwritten. If you find one that doesn't share that, let me know, because I'd love to interview them. But that's the truth. Like, you can literally, if you just change an exit cap rate from a 6% to a 5.5%, like, it can have a dramatic difference. So understanding where cap rates are, understanding where they're going to be, and then making sure you've got the debt that can support that doesn't put you in a position where you're going to have to sell when there's potentially a downturn in the market. Because ultimately that's what we're dealing with today. And that's how a lot of passive investors, or why a lot of passive investors are losing money today and getting a really bad taste in their mouths for what we do here.
Yeah, and I think that's why it's important to understand why investors may invest, through someone like you, right, instead of maybe going directly to an operator. You understand these investments, you're looking and doing the due diligence that we spoke about, not just on the operator, not their track record, but the underwriting. You're checking out off all the boxes that you like to see, and ultimately they're investing in you with the confidence that you're doing a lot of that stuff on the back end. So that brings me to the next point of fund-to-fund structures, and that being a more common way to invest. So can you speak about what a fund-to-fund structure is and why someone would want to or should look into investing through a fund-to-fund rather than maybe going directly to an operator themselves?
Yeah, good question. So fund-to-fund is, you hear SPVs, fund-to-funds, blind funds, like, there's all kinds of different terms that are thrown around there. But ultimately, your decision is, do I invest directly with one of the operators that I know, or do I leverage another expert that can help me get access to better deals and better economics potentially by leveraging their expertise and their connections and their time, energy, effort that they spend finding these deals. So ultimately, what a fund of funds is, or an SPV, is where folks like you or I reach out to our network and see who might have interest in investing in real estate. From there, we pool investor capital to invest in large operators, well-vetted, carefully vetted opportunities. And the benefit that we're bringing to those operators is that we're bringing one big check to them, so they don't have to deal with investor relations for the 30 to 50 different investors that we're bringing into one deal. And then our investors get to take advantage of our network, our expertise, and our due diligence process in finding the best deals. So at a high level, our investors should get approximately the same or better returns by investing with us, but they get to take advantage of all of our expertise and knowledge and know-how in the space. So that at a very high level is what a fund of fund is. Now, very specifically, what it means is, folks like Bryan and Chris and I, we are constantly vetting deals and operators, and they will come to us to see if we have an interest in their deal. And if we do, then we will actually work with our SEC attorney. We will set up the entity structures and the legal paperwork to create a fund. And then our investors come and invest into our fund. And then we take that one check and invest with the large operators. So we're essentially investing in other people's deals as a limited partner from the fund standpoint. Does that make sense?
Totally.
Okay. It does. And I really like how you've kind of called out the benefits to both sides of the coin there, right? Like, this isn't just about how does it benefit the operators, how does it benefit the limited partners. It's really, how does everybody in this process benefit from leveraging their area of expertise? So whether that is the operator having the expertise on operating the property versus potentially not having the capital, and then the investors having the capital that they ultimately want to invest. You marry those two together, and that's hopefully where you have a performing investment and ultimately a performing asset.
Yeah.
A lot of people assume that the only way to invest in one of these is through cash, their savings, stuff that's stuffed underneath the mattress potentially, right? Like, there's the misconception here is that you have to have the money physically available, sat in your bank account or in a savings account somewhere to invest in this. Can you talk to us a little bit more about other opportunities that people might have to invest in these that isn't directly through just cash that they may have?
Yeah, yeah, absolutely. So something that's kind of unique in this space that a lot of people don't realize is they can actually invest in these type of opportunities through an IRA, a self-directed IRA. And probably the second step that most people don't realize is that you can take a 401k from a previous employer and transfer those dollars into a self-directed account. In fact, that was actually the way I invested in my first handful of passive investment deals, was through exactly using that model. So a self-directed IRA is essentially, it's very similar to a regular IRA, but you have the ability of investing in alternative investments with this. And that can be like gold and silver, that you can actually invest these in the stock market if you want. You can buy houses with these. You can invest in alternative investments, like literally whether it's multifamily, ATM funds, industrial, office, whatever. You can invest in all kinds of different options with these. The only caveat is that you cannot be directly involved in the day-to-day operations or management of those funds or that investment. Okay. So my example, I had mentioned I worked for a large organization for 10 years before I went to my last employer. I had almost $500,000 sitting in an old 401k that I had moved into an IRA, and I just had it sitting in the stock market. So when I decided I wanted to start passive investing in alternative investments, specifically mobile home, when I first got started, I was able to move $100,000 from that old IRA into a self-directed custodian. And then that custodian helped me place that capital into this particular fund that I was interested in. So the self-directed IRA custodian is essentially, it's an entity, it's a management structure where their sole purpose is to protect the tax benefits of those dollars sitting in the self-directed account. So you don't put yourself in a situation where you might accidentally create a taxable event, because nobody wants to get a tax bill on accidentally putting $100,000 somewhere where they shouldn't and get, a $35,000 bill at the end of the year. So their sole responsibility is to make sure that you invest in projects that you're allowed to invest in, and then don't pierce that tax protection that's already there. So what it does is it creates this opportunity for folks that have moved from job to job in the last 10, 15, 20 years, and it makes those dollars available to invest in these type of opportunities, which for me, it was really, really advantageous because I didn't have cash just sitting in the bank at the time because I had all that tied up in these houses. And it allowed me to kind of dip my toe in this space just to see if this is something that I really wanted to do in the long run. And sure enough, I started getting distributions that were paid right back to that. And then when the next bonus check came, $50,000 went in cash into the next deal to create what I call livable income now, because now I'm actually creating cash income that I can live off of, God forbid, that the pink slip comes. So
yeah. And so a couple of things I wanted to mention there too. How long does that process generally take if someone does have an old 401k sitting from an employer that is just there and they don't know what to do with, and this is an option that they just learned about? How long does that take to generally transfer to custodian where they can invest? And then when they do invest, right, the proceeds and the cash flow from that investment has to flow back into the IRA. They can't take it and pocket it themselves, right? They can't go and spend it somewhere else. It's got to go back into the IRA, correct?
Yep, exactly. So, well, and that's a really good point too. So working with somebody like you guys or with me, they're going to know how to set up those accounts so the dollars go to the right spot so you don't create that taxable event. And then the first question was, I apologize, what was the first question?
Timeline of the process.
Timeline. Yeah, so it's all over the place. I will tell you, if you're working with a good self-directed IRA custodian, it can be as little as like 10 days. If you're and it's just like anything. There are good self-directed IRA custodians and there are bad self-directed IRA custodians. So if you're working with Bryan and Chris or myself or anybody else that has well-established relationships, you can feel pretty comfortable that you should be able to get that completed in about 2 weeks or so.
And then the one thing I wanted to also hit on, aside from the self-directed IRA, that's an awesome avenue to explore and one that Chris and I have talked about because similar, we both have IRAs that are being held with, another Fidelity. I know, and Fidelity won't let me invest in a real estate asset through their IRA. So that's an avenue that I'm looking to pursue as well. When we go back to investing in cash, one thing that you were big on was creating like $100,000 of passive income over 5 years. Can you talk about that a little bit? Your strategy, just your thought process of how do you create and generate passive income? So when someone gets started in their first investment deal, right, they might see a few $100 come in a month, or a few, maybe $1,000 a quarter, right? Where and what is your strategy when you look into really compounding that passive income to create, a lot more passive income when it comes to a yearly basis?
Yeah. Yeah. And thank you as well. I think a lot of people get into the space. Everybody's always looking for how to get rich quick. And there is no surefire way of getting rich quick. Let's just say that first. As you mentioned before,
That's
this
legal.
is a get rich over time process. Okay. But the general performance, going back to that $20 PowerPoint presentation that I shared earlier, most of these will have a performer that's talking about doubling your capital every 5 years. Okay. So if you take that idea and you compound that over 5 years, one could argue that $100,000 placed in these type of deals every year for the next 5 years, at year 6, your first deal should go full cycle, doubling that 100,000 to 200,000, essentially creating $100,000 in profit. Now, if you take the original $100,000 that you initially invested and you reinvest it, you're planting that seed for another 5 years from today. So whatever amount of income that you need to create, you need to invest that dollar amount every year for the next 5 years. And on average, it will kick off that same dollar amount every year moving forward. And there are tax benefits as well, which play into this. And we're not CPAs or consultants, or we're not giving financial advice or anything like that. But it is tax advantaged dollars that you start creating on the back end once you do this. And there's a number of different strategies and techniques that will go into that. But at its simplest form, if you need to make $100,000 a year tax free, invest $100,000 a year for the next 5 years. In year 6, on average, you have achieved that goal. Now, if you need to make $200,000 a year, 300, 500, whatever that number is, you've got to start investing today and invest often, and that will get you there.
How did you find that process, Randy? I'm assuming you didn't go, here's my self-directed IRA into the first deal, here's a mobile home park, there's $100,000, I'm just going to put all of my eggs into one basket. How did you, and I believe you're in around 25, 26 different individual investments at this point. Like, how did you balance that out between the different asset classes so that you weren't just putting all of your eggs in multifamily, for example?
Yeah. And I think that's it's an important question. I had no idea what I was doing when I first started. I wrote far too big of a check and put way too much money in the first deal. But over time, my diversification strategy evolved, and ultimately, it's the same diversification strategy now that I offer to my investors. And the goal here is to diversify across asset classes, operators, geographies within the country, business plan. And now I'm also including vintage as well. So it's almost like the dollar cost averaging idea, but across multiple different investment picks. So in my 25 LP positions, I have investments between $25,000 and $100,000. And I'm across, I think, 7 different asset classes, and I'm across 11 different operators. So if any one operator, any one asset class, any one region in the country sees a dip, then it doesn't impact the entire portfolio. And that's the advice that I give to my investors as well. Chris, you and I were talking the other day that, sometimes big check writers will come to you and say, I want to place a very large check amount. And the not so intuitive response is to say, no, I don't want to take that check. I would actually encourage you to spread those dollars across multiple deals. But at the end of the day, I need to share the same knowledge with my investors and experience that I've gained in what I'm doing with my own dollars. So if I had $500,000 today, I would go find probably 10 different investments to place $50,000 in and place it over the course of the next year or 2 years, quite frankly. So that's really how I've developed my strategy. It's how I pick my operators. It's how I present deals to my investors with the goal of, investing across all those different diversification channels.
Yeah, and that's a great point. And I think great strategy and advice to new investors who haven't gotten started and really get the ball rolling and to start thinking about how to diversify in the space. And that gets me to think about also, I know you have another type of investment, debt fund. Why would a debt fund versus an equity play maybe be a different kind of investment that an investor would consider or look to pursue as well?
Yeah. So it's interesting. My journey, going back to what is it that you're trying to achieve with your investment dollars? Are you trying to create cash flow? Or are you trying to create equity growth? Or are you trying to create some type of combination of the two? For me, when I was making, strong 6-figure plus income for years and years and years, I didn't really have an income problem. My goal was to really grow that nest egg as fast as I could, because my thought was when I hit X amount of dollars, that becomes my exit plan, essentially. Mm-hmm. When I got laid off, I became a cash flow investor, all of a sudden, right? Mm-hmm. Granted, I had a 6-month severance, but I knew at the end of 6 months, I either needed to have a business that was kicking off X amount of dollars to support my lifestyle, or I needed to have investments that were kicking off that type of cash flow. And if you're a high W-2 income earner and all of a sudden that cash is gone, you now are a cash flow investor. And what it's done is, as you get further down and closer to your exit, you will likely become more of a cash flow investor because you need to cover those expenses. So why do a debt fund versus an equity? It's because you're a cash flow investor, or at least you want a portion of that in your portfolio. The challenge with a debt fund is that while it may be liquid, it might be paying 8% plus. You're giving away, or you're not able to take advantage of the big equity upside that you get with a traditional syndication. So for me, I am starting to blend my portfolio where I have more cash flow investments than the equity, because I've built that nest egg where I want it. Now I need to create livable income with it.
That's a good point. Go ahead, Chris.
Yeah, I was going to say it's a really interesting point of view, and I think it goes back to everybody having to understand truly why they're going through this. What is it that you're trying to achieve with these investments? And again, that's one of the most important questions that everyone should either ask themselves or be asked as they're going through this process. What lessons would you say you've learned today? You've been sharing a lot of quite important ones. I think, again, you've gone through the highs and lows, right? You've had the high performing W-2. You've gone through the lows of being laid off. The second time round, you felt a lot more comfortable. Obviously, hindsight's a wonderful thing. But again, what 2 or 3 key things that you would recommend everybody ultimately sit down and do as they start to think about investing?
Yeah, well, I mean, first and foremost, they're already doing the first suggestion, and that would be get educated in this space. So they're listening to your podcast. I'd encourage you to listen to a bunch of other podcasts and get in the know and hang around people that are not just stuck in this. I'm going to invest in my 401k and that's going to save the day and I'm going to be fine with that. Okay. After you get into this and you get educated and you start to get excited about the space a little bit, I'd encourage you just to sit down either on your own or with your spouse or whoever that decision unit is and decide like what portion of our investable capital do we want to allocate towards these types of investments. Okay. Once you know what that is, I encourage you to jump in and follow the diversification plan that I've shared. So 1, get educated. 2, figure out where you want to invest or how much you want to invest. And then 3, take action. And what I'll share with you is that I started like everybody else. I placed my first investment and then the following year I did more. The following year I did more. And now when my wife and I sit down, we decide from year to year, like what percentage do we want invested in these type of investments that will help us achieve our long-term goals. Right now, we're about 70% alternative investments, 30% traditional S&P, index fund type investing. But that's evolved quite a bit over the last handful of years. So those lessons.
And I think you raise a really good point there, Randy, as well. What we're not trying to talk about here is that you should move every single one of your current dollars into real estate or any other alternative investments, right? This is the opportunity to invest in something that otherwise I certainly thought the only option to do investing in real estate was to go and get a mortgage, was to buy the second home, right? And now that I've kind of dived into this space, I'm seeing deals all over the place that previously I was like, why did I never, ever get to see any of this? All anybody ever told me was invest in your 401k, max out your 401k as much as you possibly can. And then by the time you go through this process and retire, you should have enough money in the bank account essentially to support you through that. Which again, I think is really, really important. The purpose here is to give you other opportunities to invest, to grow the money for your future.
Absolutely.
Yeah, and that's a good point too. Like when you were mentioning that, I think there's still an important aspect here to be diversified, and we still believe strongly in the stock market, the stability, the S&P. It's performed how it's performed for all these years for a reason, right? So there's still a thought process to keeping your money in the stock market to some extent, but also everyone knows the power of real estate, a tangible asset, the values, the tax benefits, and everything else that come along with it. And it's a great diversification avenue. And so I guess one of the things that I think about, and I guess I never asked you this in our conversation, is how different does your personal wealth and portfolio feel from when you were a W-2 active employee in, say, 2018 to how you look at your portfolio now? And I guess this is a little bit more of a personal question, but since you've been doing this for a time, right, and this is, you're years ahead of where Chris and I are in this journey, how do you look at your personal investment, your wealth, and think about this now? And are you happy with where you're at? And where does it, the next 5 years look like for you in your personal journey?
Yeah. No, thank you for asking that. So, yeah, I would say like comparing and contrasting from where I was to where I am today, like going back to 2018, I was scared. And I thought that I was going to have to work until I'm 65. And, in sales, you go to bed a hero, you wake up a zero, you start all over every quarter or every month, every quarter, every year. Right.
Yep.
And the thought of having to do that for another 20 years, like that was not an exciting thing for me at all. Okay. I had a good sense that I was going to be okay. My wife and I would be taken care of. We may or may not be able to live a luxurious life for the rest of our lives. But that's kind of where I was then. So where I am today, probably more than anything, I feel like I'm in control of my finances more than I ever have been before. I remember back, like my dad retired after 35 years in the LA County Sheriff's Department. and he lost 30% of his net worth and had to go back to work like a year and a half after he left because of the stock market crash back in 2000. I don't have that fear anymore. I feel like I'm in control. I feel like the upside is probably 10x compared to where I maybe even more than 10x. And the next 5 to 7 years look extremely bright in the real estate space. So, that's a really good question. I haven't even thought of it in that perspective, but it puts a smile on my face to know where I am today compared to where I was back in 18. So, thank you for asking.
Of course. And I guess that leads me to my next question to play off that is, what's next for impact equity? The market cycles within real estate, right? We've just gone through a bit of a low cycle with rising interest rates and what's happening to some of these deals and operators. What is your perspective on the next 5 to 7 years? Why is now maybe a good time to get started in some of these investments? And what is the impact equity strategy going forward for the next 5 to 10 years?
Yeah, so our goal is remarkably very, very similar to what it was when this was launched 2.5 years ago. But the goal today is to refine the offering down to probably 4 to 7 different operators that I am very, very close to, that I influence, that I know very, very well, to keep providing the diversification, not only for my investors, but for my own investment dollars as well. So continuing to refine and improve upon that due diligence process. I see partnerships will become more and more important for what I'm doing. You and I have kind of started to walk down that path to a certain extent, and I'm really going to that next level, looking for people that can help me grow what I'm doing with impact equity, because my goal ultimately is to help 1,000 investors reach financial independence through this channel, because I truly do believe that every single person in the W-2 world should have at least a portion of their investable capital tied up in alternative investments. Because if you get to a point where you have, like, even if you had $5,000 to $7,000 per month in income coming in from your investments, I think it would change the trajectory of so many people's lives, and it would just give more options and bring more happiness to their lives. So impact equity, we're going to keep growing. We're going to keep partnering. We're going to keep finding good deals. And I'm going to keep teaching other people how to do what I've done.
That's amazing, Randy. And again, like you said, we are kind of starting on this journey and partnership as well. Where can people find you? Where can they get in touch with you? Can you just share where people can find you and impact equity?
Yeah, absolutely. So the easiest place is LinkedIn, Randy Smith on LinkedIn, but the website is impactequity.net. And of course, I do have a podcast that comes out every Thursday morning. It's called The Gentle Art of Crushing It. And we interview operators and passive investors and vendors that apply to the passive investing space.
Perfect. Well, again, a huge thank you, Randy, for joining us today. We really, really do appreciate you taking the time, sharing your expertise. We'll add all of Randy's information in the description so that you can quickly click on that link. But again, huge thank you for joining us today, Randy.
Yeah, thanks so much for having me on the show, guys. I'm excited to see what the two of you guys do. I'm really excited about the future of Seven Peak as well.
Thank you. Yeah, this was great. You provided a ton of value. So talk soon. Thanks, Randy.
Thank you for tuning in to the Peak Profits Podcast. We hope today's episode was not only inspiring, but packed with actionable insights for your passive real estate investments. Subscribe so you never miss an episode. And if you enjoyed the show, please leave us a review. Your feedback fuels our passion to bring you even more valuable content. Stay connected with us on social media and visit 7peakcapital.com for exclusive resources and updates. Until next time, keep striving towards your financial goals, and let's reach new peaks together.